The Reserve Bank's inflation fighters have put away their weapons because they're more concerned about the uncertainty surrounding the debt-riddled US and Europe. But the RBA also notes that parts of the domestic economy were slowing more quickly than expected, as it kept official interest rates at 4.75%. Some analysts say it's a sign the RBA's inflation-fighting zealots have been converted to a more moderate path. Philip Lasker reports.
Whether it's furniture or food, households are cutting where they can.
People have changed their habits in somewhat of a fear that they may not have enough money to pay the fixed bills, electricity, rent, petrol, things they can't get at a cheaper price.
To say the consumer is cautious is an understatement, according to some. They say households are in recession.
When you have a look at consumer spending per head of population in real terms, what we can see is the growth rate's at an all-time low over the past 50 years. And so households have really been very cautious. They're holding back their spending, and spending now has been negative for 3 years, and it's back to what we saw it was in the early 2007.
So it's no surprise Craig Cook was cheering today's Reserve Bank decision as welcome relief for both his customers and his business.
Every time you're confronted with an interest rate rise, on top of all the other rises, electricity, carbon tax, things that are coming, it all comes out of the bottom line. And interest rate rises on finance, we just find very, very hard to deal with because we can get no more for our product.
And the Reserve Bank Board acknowledged the difficulties. Its statement mentioned the noticeable dampening effect cautious households were having on the economy and the rising concerns over the public finances of both Europe and the US. Some say the RBA has changed its priorities.
Gone is that previous jawboning we've seen over a period of time and looking towards the horizon for worrisome inflation and using that as justification to raise policy in the now. Instead, what we have here is a recognition of the global downside risks and some nascent concerns about the domestic economy.
The board concluded it was prudent to keep the official cash rate at 4.75%, particularly in view of the acute sense of uncertainty in global financial markets in recent weeks. But the board did take the opportunity to say it was concerned about the pickup in underlying inflation.
Given how worried they are about inflation going forward, yes, I think on balance, interest rates will go up over the course of time, but the RBA is making that conditional. They're making that conditional on things not getting worse in the world.
Whilst we do have that dampening effect from both a weak consumer and a rising exchange rate, we still have the fact that inflation is rising and it's showing no signs of stopping.
Traders sold off the Australian dollar and market interest rates fell, partly due to events in the US. For the first time since 2008, the 10-year bond rate dropped below the Reserve Bank's cash rate. And if it stays there, that's the market telling us they expect the Australian economy to slow from here and interest rates to be cut. The Reserve Bank is still a long way from admitting that.